This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Strong start. The Dow and the Nasdaq enjoyed their best start to a year since 2006. But what should investors make of all that euphoria?
We're hiring. The unemployment rate stands at a 17-year low. Jobs seemingly everywhere, but there's a shortage of labor in two critical industries.
The new corner pharmacy and why that means never actually walking into a store. It's this month's Bright Idea. Those stories and more tonight on Nightly Business Report for Friday, January 5th.
Good evening, everyone. What a start to 2018. Stocks are up a lot. The weather may be frightful, but inside Wall Street, it is delightful. Companies are hiring. Optimism is high. The Dow and the Nasdaq recorded their best starts to a year since 2006. And today's not too hot, not too cold employment report helped drive all of the major indexes to fresh records. Again, the Dow Industrial Average advanced 220 points to 25,295. Nasdaq added 58, and the S&P 500 was up 19. For the week, all of the major indexes posted solid gains, and with those gains comes an increase in stock market optimism, which we should point out is not always a good thing. Bob Bazzani reports tonight from the New York Stock Exchange.
The December jobs report was below expectations and the market seemed relieved. Now, why would they be relieved? Because the economic reports have been so strong recently that traders are beginning to worry that the Federal Reserve might be more aggressive raising rates to slow down an overheating economy. But today's jobs report was just about perfect. It was still strong. It wasn't as strong as the experts thought it would be, so it reduced the chances the Fed would get concerned about an overheating economy. The markets are at a critical juncture right now. The markets have had a big start to the year. Haven't you noticed? The S&P is up over 2% in the first week of the year, and everything seems to be up. There are some signs traders are getting a little euphoric. A lot of people seem to believe that the economy and wages and earnings are really going to take off in 2018. That's a little bit worrisome because one of the best things the market's had going for it in the last 7 or 8 years is just how hated the rally has been. We've talked about this a lot. So now people are starting to like the rally, and some people are starting to like the rally a lot. And that makes a lot of people, including me, a little bit nervous. Now, next week, earnings season starts, and expectations are very high. Traders aren't just expecting earnings to beat expectations by a few pennies. They want a lot more than that. They want more buybacks. They want more capital investment. They want kind of like the whole enchilada. You see what I mean? With expectations this high, the markets will likely have some issues delivering. For Nightly Business Report, I'm Bob Bassani at the New York Stock Exchange.
That December jobs report that Bob just mentioned saw the pace of hiring slow in the final month of 2017, but it capped a strong year overall for the labor market. In December, non-farm payrolls rose by 148,000, which was below expectations, but the jobless rate remained steady at 4.1%. That made last year the 7th straight year where employment gains exceeded 2 million. It's only the second time in recent memory that the economy has produced jobs at that pace for that long. Hampton Pearson takes a look at the nation's employment picture.
While there was a winter chill to the pace of hiring in December, job growth in the last 3 months of 2017 averaged more than 200,000 new workers added to payrolls each month. At 4.1%, the unemployment rate is the lowest since 2000. December even saw a slight increase in wages. Average hourly earnings up 2.5% year over year, now just under $27 an hour.
We think they continue to grind higher, maybe a little closer to 3% by the end of this year. But I think if you're looking for a takeoff moment, that's probably not what we're going to see.
It all adds up, leading economists predict, to a wait-and-see approach from incoming Fed Chairman Jay Powell and monetary policymakers when it comes to tracking interest rate hikes in 2018.
I don't think that this number scares anyone and makes them want to hike any faster than they otherwise would. They're going to try to err, I think, on the side of caution.
I think right now the Fed doesn't mind if inflation runs a little bit hotter and people get wage gains.
Construction and manufacturing led the way in job gains in December, adding 30,000 and 25,000 new workers respectively. The unemployment rate for African Americans reached a record low of 6.8% last month, down a full percentage point over the last 12 months.
87 months of continuous job growth is an outstanding trend. And to see the African American unemployment rate down below 7, where it had been in the 15% range, is very good news.
The biggest job losses occurred among retailers, cutting more than 20,000 workers last month and 67,000 for all of 2017. As 2018 begins, the job story is on 2 tracks. Will the pace of hiring continue to slow down as the labor market nears full employment? Or could job growth get a boost from the business-friendly $1.5 trillion tax cut package signed into law by President Trump just last month? For Nightly Business Report, I'm Hampton Pearson in Washington.
And joining us now to discuss the report's findings in more detail is Michael Gapin, Barclays' chief U.S. economist and a managing director there. Michael, welcome. Good to have you with us. This was a little bit of a slowdown in job growth, but still unemployment rate staying right where it is, earnings coming up a little bit. Is there any nit to pick here?
Not really. I think I agree with much of the lead-in that you just had. I think a lot of the slowing can be explained by a post-hurricane return to normal. If you just look back a few months when the large hurricanes hit the U.S., hiring virtually stopped in the month of September, and we had some catch-up to do in October and November. We were running at above trend in terms of hiring in those 2 months. So some slowing and a return to normalcy was expected. I think that was part of the story. And then I think the other factor was just an outsized decline in the retail sector, as you just mentioned. But that's not a new story either. Online retailing has been taking an ever greater share of that type of transaction, and we've seen a reduction in employment from traditional brick and mortar stores. So I think that largely accounted for the underperformance, but the rest of the report looked good, and I think hiring will continue at a robust pace through the remainder of this year.
Michael, how do you feel about the gain in hourly earnings? Because with the unemployment rate as low as it is, and the fact that companies are getting a big tax break, Americans are getting a tax break, a lot of people feel as though wages will start to accelerate. We had a 0.3% increase. How do you feel about that?
So this has been a bit of a conundrum where the unemployment rate, as you mentioned, is reaching 17-year lows, but wages have yet to pick up. I think I would just suggest look at this in a slightly broader context that more than just labor scarcity determines wage growth. Inflation has been soft and productivity has been slow. When you account for inflation and productivity, wage growth is about where it should be. And I agree it will move higher from here. I also think it'll approach, say, 3% by the end of the year. So I think it's just going to take a little bit more time, but it'll still be subpar relative to prior recoveries.
You know, I know that veering you off into market talk is maybe not what you do, but are you concerned at all that there's a little too much euphoria in the economy right now, that things are a little too nice?
Things are quite good, both domestically and abroad. I mean, we often focus on the U.S. exclusively, but growth outside the U.S. has been quite good for the past 4 quarters and even accelerated. So globally, virtually every industrialized economy is growing, and we're benefiting from that as well. I do kind of believe we're priced to perfection here. The biggest risk to asset markets or the equity market would be if wages picked up in a meaningful way and inflation did begin to rebound, then you'd bring the Fed into play. Right. But right now things do feel Goldilocks. As you mentioned, it was a not too hot, not too cold employment report, and I think that's what markets are reacting to.
All right, Michael, thank you so much. Michael Gapin with Barclays.
As we've reported, manufacturing was one of the industries that led the way in job gains in December. In fact, that sector has added more than 200,000 jobs over the past year. It's a remarkable turnaround for an industry that was beaten and bruised not that long ago. But there is another problem, and it is a worker shortage. And nowhere is that more evident than in one manufacturer in Burns Harbor, Indiana. Kate Rogers reports on where the jobs are.
I will be the greatest jobs president that God ever created.
Donald Trump campaigned as a jobs creator with a promise to revive American manufacturing. Since the election, manufacturers have added 171,000 jobs, encouraged by deregulation and corporate tax cuts, as well as stronger global growth and a weaker dollar. But this job growth is facing one major headwind: a shortage of skilled workers. It's particularly evident in Indiana, where reliance on manufacturing is outsized relative to other states, with 20% of all employees working in the industry.
We have had a record number of job announcements over the last 12 months, but it also creates issues in trying to get people to come to Indiana and work here.
On top of that, a population issue. The Indiana Manufacturers Association has even floated the idea of creating financial incentives to lure workers to the Hoosier state to fill vacancies.
We need people to move to our state. It is estimated that our workforce population is going to grow by 1% between now and 2040, and the national average is going to be 18%.
It's an issue steelmaker ArcelorMittal knows all too well. The company employs 18,000 workers here in the U.S. and is looking to add an additional 1,000 employees in 2018. But attracting talent in a tight labor market can be challenging, which is why the company created its Steelworker for the Future program.
It's really a partnership of us with high school graduates where we assist them with their college education, but also provide for them the opportunity for hands-on training in our factories.
The steelmaker has hired 90 former participants and currently has 144 students enrolled. Dantrell Brooks is a recent graduate.
My senior year of high school, everybody's talking about big name college universities, going there 4+ years to get a degree. Well, I saw ArcelorMittal as a 2.5-year degree, less than half the time, guaranteed job, training, craft, and I knew I had to go for it.
From engineers to technicians to supply chain managers, ArcelorMittal is recruiting heavily and hoping to usher in the next generation of talent like Brooks.
This job itself is the #1 job out there.
For Nightly Business Report, I'm Kate Rogers in Burns Harbor, Indiana.
Still ahead, stocks that could benefit as Washington continues to push deregulation. Our market monitor names names. The trade deficit rose more than expected in November to a 6-year high. The gap widened to more than $50 billion as imports of goods surged to a record. Part of the rise also due to price increases. The White House says that a smaller deficit, along with tax cuts, could increase economic growth.
The White House will reportedly ask Congress to approve $18 billion in funding for a proposed border wall along the U.S.-Mexico border. As first reported by the Wall Street Journal, the request would cover construction of the wall over a decade. There are also reports that this issue will be discussed at a Camp David meeting this weekend, attended by the president, cabinet members, and congressional leaders.
Well, we just talked about the need for workers in the manufacturing industry, and the same is true these days in construction, where builders are looking to hire like mad to meet demand for new homes, apartments, and other buildings. All signs point to a very big year in construction, but as Diana Olick reports, there's a major obstacle standing in the way.
Call it the year of the crane. Both commercial and residential construction are set to soar this year, and the hiring and spending has already begun. Even in December, with much of the nation frozen, the construction industry added 30,000 jobs, according to the Labor Department. For all of 2017, construction added 210,000 jobs, a 35% increase over 2016. Construction spending is also soaring, rising more than expected in November to a record $1.26 trillion, according to the Commerce Department. Spending increased across all sectors of real estate, commercial and residential, with particular strength in private construction projects. Even contractor optimism is up to the highest on record. 3/4 of construction firms said they will hire more workers this year. That according to the Associated General Contractors 2018 Outlook Survey. The only trouble will be finding those workers. There's a severe shortage of skilled construction labor for buildings, infrastructure, and especially for residential housing. This as demand for housing heats up, supply sits at record lows, and builders are cash strapped.
The cost of construction going up very rapidly because of the repairs and the shortage of supply in the single-family market. So I think those pressures are going to come through, and you are going to see some wage gains, minimum wage gains, as well as some wage gains because of acute labor shortages.
Expect those gains to be passed on to buyers in ever higher home prices. For Nightly Business Report, I'm Diana Olick in Washington.
Brazil says no to a potential merger between Boeing and Embraer. And that's where we begin tonight's market focus. Boeing is reportedly working on easing Brazilian government concerns over a potential takeover of its rival. Brazil's government owns a golden share in Embraer, and that allows it to veto any deal. Brazil said it would welcome a partnership between the two companies, but nothing involving any change of ownership of Embraer. Boeing shares took off, rising 4% to $308.84. Shares of Embraer fell 4% to $25.76. An $80 million payout tied to an antitrust dispute caused Cal-Maine Foods to post a quarterly loss. Those results, along with revenue, missed expectations, and the egg producers said it would not pay a dividend for the first 2 quarters of 2018. Cal-Maine shares got crushed, down nearly 7% to $40.80. Constellation Brands reported a worse-than-expected drop in sales as fewer customers bought wine and spirits. The company expects that weaker demand to continue, saying sales for those products would be at the low end of initial guidance. Constellation Brands hiked its overall profit forecast and said it was launching a $3 billion share buyback. Nonetheless, shares were off 2% to $219.88.
Deutsche Bank said it expects to report a small net loss for 2017 following new tax legislation and low levels of client activity in the latest quarter. The bank initially expected to report a profit for the full year 17. Investors disappointed, shares down 6%, $18.55 the close. Barnes & Noble shares continue to fall today following the retailer's announcement late yesterday that its holiday sales weren't very merry. The company now expects store sales for the full year to be down in the mid-single-digit range. The bookstore giant also pledged to keep its costs under control. Shares off nearly 14% to $5.60.
Time now for tonight's Market Monitor, who has 3 stock picks he says will likely benefit from deregulation. They all pay a decent dividend as well. Last time he was on in April, he picked BCE Media, up 4%, PPL Corp down 18%, and AbbVie, which is 57% higher. He is Oliver Portia, Chief Market Strategist at Bruderman Brothers. Welcome. Nice to have you back, Oliver.
Thanks for having me.
So deregulation and good dividends, that's the theme. Your first stock is Royal Dutch Shell. What's the dividend like?
Well, the dividend is pretty good. It's above 5%. And more importantly, as President Trump just announced that he is planning to open up offshore drilling, explorers like Royal Dutch Shell are really going to win in this. This is going to take some time, but through that speculative process, and as to whether it happens or not, these shares are likely to climb solidly, and it's a strong company, good dividend, in a good environment where growth is picking up globally.
Verizon is your next pick. It is a very competitive space in which Verizon operates, obviously, but you think the repeal of net neutrality will make Verizon a winner. How and why?
Yeah, amongst others, but Verizon is somebody that's pushing out content, and they're able to raise prices, and they're the market leader out there, both in terms of cellular but also business services that they offer. And so from our perspective, if we have to pick one, and we're obviously diversified in the telecom sector like all other sectors, we think that Verizon is a strong bet. And it has a good dividend above 4%. So again, that dividend theme is very important to us.
Speaking of competitive spaces, the retail industry, online and brick and mortar, but you like Walmart. Why?
Yeah, the tax cuts are going to benefit Walmart's key constituents, key customers. And so we think they're going to see a pickup in sales there. We also very much like their acquisition last year of Jet.com, and so that makes them competitive against Amazon in certain areas. So we think that Walmart is attractively priced, provides a good value. The dividend isn't great, but at 2%, it's not bad either. And so, again, we think that that stock is going to do fairly well in 2018.
These are real bulwark kind of companies, Oliver. Are you worried at all that euphoria is getting a little out of control?
I don't know if I'd use the term euphoria. I think there's some strong fundamental reasons as to why the markets are trading where they are today. That doesn't mean that they're cheap by any measure. What I'm worried about, and what we are spending a lot of time looking at, is where the performance divergence is going to come from next year. I think you're going to see certain sectors do very, very well and other sectors not do so well. You know, you saw that last year with utilities. The first half of the year, utilities did very well. The second half of the year, they did very poorly. And we think that similar type of performance metrics are going to come through in various sectors next year.
Oliver, thank you so much. Have a wonderful weekend. Oliver Porsche with Bruderman Brothers. To read more about his stock picks, head to our website, nbr.com. Coming up, one startup's new prescription in the pharmacy business. It's tonight's Bright Idea.
An update tonight on a story we have been covering for you. Apple plans to release a patch for the Safari web browser on its iPhones, iPads, and Macs within days. This after chip makers disclosed flaws that could make a lot of devices, including PCs, Android phones, and other devices, vulnerable to hackers. Yesterday, we told you that Microsoft had updated its Explorer browser and that Google had updated its public cloud service.
Uber co-founder and former CEO Travis Kalanick reportedly plans to sell nearly a third of his stake in the ride-hailing service. According to Bloomberg, Kalanick will sell 29% of his Uber stock. He had long boasted that he never sold one share of the company he started. The stock sale comes as a Japanese firm SoftBank prepares to buy a stake in the company.
Did you ever find yourself wondering how much your medicine will actually cost when you go to the pharmacy, or trying to discuss health issues in front of other customers when you're there? Well, prescription drugs, a $400 billion plus business in the U.S., but only 1% is conducted online right now. One New York City entrepreneur got the bright idea to relieve some of the pain points with a digital full-service pharmacy.
When Eric Kinariwala went to his drugstore to pick up a prescription medication in January of 2015, his headache was just beginning. He waited in line nearly an hour before speaking to a pharmacist.
She said, "I'm so sorry, we're out of stock of Z-Paks." And I'm kind of thinking to myself, it's January, like this is the only thing the pharmacy should have. I can't believe that this is an experience that exists on every street corner in America.
It's a problem that's getting worse. 42% of the respondents in a 2016 survey said their pharmacy was out of stock at least once, causing them to make a return trip, up from 33% back in 2013.
He put the script on hold.
Struck by his own frustration and pulling on his background as an investor in the healthcare, retail, and technology fields, Kinariwala came up with a concept for an online pharmacy. He refined it for more than a year with an old friend, pharmacist Sonia Patel.
Most pharmacy systems are built on technology that was founded maybe 20 years ago, and it didn't work for the pharmacists, it didn't work for the consumer, and it also didn't work for the doctors or insurers.
They found these healthcare players need better communication tools, that pharmacies have to improve inventory systems, and that customers want transparent pricing. Aiming for solutions, they opened Capsule in the spring of 2016. Available only in New York City, customers can order online or ask their doctors to do it for them. The company says tens of thousands of people and thousands of physicians are using Capsule. Like other pharmacies, Capsule negotiates prices with wholesalers and takes a cut from the retail sales. Capsule does not discuss whether it's profitable just yet. Customers can pick up in person in Manhattan, but most opt for free delivery. A team of 60 couriers, staff employees, often braving the elements, deliver anywhere in New York's 5 boroughs.
The business opportunities are huge. I'm looking at our prescriptions.
Dr. Jeffrey Dobro, chief medical officer at One Medical, isn't just telling his patients to shop around for medications these days. He's doing it himself, because he's finding better prices online for his own medications, sometimes less than half the price his pharmacy benefits manager, or PBM, gets at CVS.
2 out of 5 were wildly mispriced. I just cannot imagine what the average consumer has to deal with.
Why the difference?
What the independents do is try to find the cheapest price they can across the market for each individual medication. The PBMs are looking at a bundle of medications. It may be several thousand medicines. For the insurance company, the bundle's less expensive, but for an individual consumer, one particular drug may end up being much more expensive.
Capsule alerts customers when it can beat their insurance company's price, but the company prefers not to be called an independent pharmacy. It has big plans.
We will absolutely expand the business nationally and internationally over time, because we think the business works everywhere.
Confidence that comes from experiences like the one Sonia Patel had texting with a customer only weeks after Capsule opened.
She said, "Hey, Sonia, can I take iron supplements while I'm pregnant?" And then it was this ... By the way, is it weird that you're the first person I'm telling I'm pregnant? My husband doesn't even know yet. And we just had this amazing moment of, wow, we built this experience that people have an incredible degree of trust in.
Well, pharmacists have long ranked high in surveys of the most trusted professionals, but Capsule views healthcare as an ecosystem, and it's hoping to help doctors, insurance companies, drug makers, and patients work more effectively together.
Before we go, here's a look at today's rally on Wall Street. The Dow advanced 220 points. The Nasdaq added 58, and the S&P 500 was up 19. Weekly gains were strong, and the Dow and the Nasdaq had their best start to a year since 2006. That's a good way to start the weekend,
Very
right?
nice start to the year.
That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Mathisen. Thanks from me as well. Have a great weekend, everybody. We'll see you on Monday.